Very good morning, friends. So I hope you made a revision of what we covered in the last session on financial instruments. We basically covered up the aspect of Index 32, and mainly our focus was on one of the core areas of Index 32, that is compound financial instruments. So we made a couple of mind maps, and I think the trail, of course, continues today as well. And I would be now focusing today on Index 109, that I would say is one of the core part of the financial instrument standard. So our focus today is going to be on different aspects of India's 109. We're going to make some mind maps, and of course we'll do some questions as well, so that we keep consolidating the learnings as we go ahead. Now, if you recall, in terms of India's 109, the focus begins with the holder's perspective, where we look at the accounting of financial assets. And in terms of accounting for financial assets, what immediately comes to the mind is the measurement of financial assets. The measurement of financial assets initially and subsequently is tackled how? So I think we're going to first make a quick mind map in terms of, just taking a recap in terms of how the measurement of financial asset takes place. Then we'll take the focus in terms of measurement of financial liabilities, and then we'll go to the other aspects of the standard as well. So let's begin with, first of all, the very first mind map, that is on the measurement of financial assets. So let's create a mind map number one. So the focus is in terms of Index 109, and we are focusing in terms of financial assets. That is the measurement aspect. So when we look at the measurement of financial assets, rather I would say, whenever you look at the concept of measurement, your mind should always work in terms of how the initial measurement would take place and how the subsequent measurement would take place based on the balance sheet date. So first we can draw a structure and take a decision. Then when we look at the measurement of financial assets, we can segregate the information in terms of two inputs. One is the initial measurement and one is the subsequent measurement. Subsequent means at each balance sheet date. Now when you look at the initial measurement, the thumb rule you would remember, all the financial assets are measured initially at a fair value. Of course, we need to consider the aspect of transaction cost as well, which I think will very shortly make another interesting chart. But there are certain exceptions where the financial assets are not initially measured at a fair value, but they are taken at a transaction value. Now, since we are doing a revision at the moment, so I think things, which were discussed a little later in the regular sessions, I think we can definitely, add on the inputs at this stage itself. So I would say when you do the initial measurement, there are two focus points which should go at the back of your mind. Number one, the initial measurement is done at a fair value. So focus one is the exceptions. The exceptions in terms of number one, a trade receivable that is recorded at a transaction price. Because as per Index 115, when you capture your revenue, it's going to be captured at a transaction price. So we don't take a fair value when you capture the trade receivable in the books. And the second exception is when you've given a loan and that loan is supposed to be recoverable on demand. In those particular cases also, we do not consider the concept of fair value. That is one focus point. Nobody will document that. The second focus point is that when you capture the financial assets at a fair value, immediately it should come to your mind that if there is a difference between a transaction value, that is a transaction price, vis-a-vis the fair value, how do you tackle the difference? Because there are a couple of questions which comes in the exams on the area when the transaction value and the fair value differs, then how do you take care of the difference? So I think I'm putting both the focus points at this stage. So we can say the thumb rule in terms of initial measurement is that it is always at fair value. But we need to keep two focus points out here. So let's put it as focus point 1. So we put this as a focus point number 1. And the focus point number 1 is looking at the exceptions. So basically we've got two exceptions where we're not going to consider the fair value, but we're going to consider the transaction price. So we can say the first one, as we said, is a trade receivable. And the second is if there is a loan which is recoverable on demand. A loan which is recoverable on demand. So in these cases, we capture the TP. Let's put it as TP, transaction price. Then comes the second focus point. The second focus point in terms of initial measurement is the difference. That once you capture things at a fair value, and there is going to be a difference in terms of transaction price and a fair value. So how do you tackle the difference? The difference between the transaction price and the fair value. So this, I guess, we are going to tackle later. So we're going to talk of this a bit later. So I'm just reminding you that you need to keep the focus points clear. Okay, now comes the input in terms of a subsequent measurement of financial assets. I think with that, I'm just going to continue the chart. So let me just take it to the next page and we're going to see how these subsequent measurements occur. So let's go to the next one. So when we're looking in terms of the subsequent measurement of financial assets, now I would say, if you remember, we did a 3-step model. And we decided that once you categorize the subsequent measurements, depending upon its debt investments, depending upon its equity investments, they land up being measured either at amortized cost approach or at a fair value through P&L approach or a fair value through other comprehensive income, which has got another two variations. One is that if you capture things at a fair value through OCI, it could be R, which is reclassification, or it could be NR, which is called no reclassification. So depending upon debt equity, you would recall a debt investments is always a case of R, and equity investments is always a case of NR. So I think first we need to make some separate input charts, identifying that in terms of equity investments, in terms of debt investments, what would be the different measurement base. But first, let's remember the 3 steps, the broader parameters which will decide the inputs. So I think I'm just going to quickly first remind you of the 3 broad inputs. So in this case, we decided at the first instance is you need to step into the shoes. You need to step into the shoes of the issuer. As a holder, you need to step into the shoes of the issuer, because you need to first of all decide that what is supposed to be financial liability for the issuer is a debt investment for the holder. What is an equity instrument for the issuer is an equity investment for the holder. What is a compound financial instrument for the issuer becomes a debt investment for the holder. So your first focus point in terms of the step number 1 is stepping into the shoes of the issuer. And once you step into the shoes of the issuer, you are able to decide the inputs from the holder's perspective. So we'll look at the instrument from the point of view. We'll look at the instrument from the point of view of the issuer. So if he says it is a financial liability, it becomes a case of debt investments from the holder's perspective. When you say it becomes an equity instrument for the issuer, it becomes a case of equity investment for the holder. When you say it becomes a compound financial instrument, then it becomes again a case of debt investment. So your focus in terms of step number one is to step into the shoes of the issuer. As a holder, you would see that if I would have issued the instrument, how would have classified this instrument from the point of view of Index 32? You would decide that if the issuer says FL or CFI, it becomes a debt investment for the holder. If it says it is equity instrument, then it becomes an equity investment. So that is approach one. You can say the first step. The second step after this, which I gave you, was in terms of doing a risk assessment. The second input which I gave you was in terms of a risk assessment. And even the third step which I gave you was again in terms of a risk assessment. So second and the third step was all concentrated in terms of a risk assessment. I'm just trying to recap the thought processes which should be there in your mind when you're looking at a subsequent measurement. Now, the difference between the step number 2 and 3, which we said, in terms of the step number 2, you're looking at, whether the risk is present or not. You're looking at the fact that the risk is present or the risk is not present. So you need to basically identify, is there a risk or is there a no risk? And there are certain tests which evaluates the same. To remind you, when you're looking at the presence or the absence of a risk, I think let's put some questions back to you as well. So in terms of debt investments, do you recall what was the test which helps you to decide whether there is a risk or not? Because there was a different test for a debt investment and there was a different test in terms of equity investments. So would you like to recall and tell me which test in terms of a debt investment identifies the presence or the absence of a risk? There were two different tests. So for the debt investments, it was a different test. And for the equity investments, it was supposed to be a different test. Anybody would like to give inputs that what was the name of the test which was helping us in a debt investment to decide the risk is there or the risk is not there? Oh my God, I did not get any answer so far. So I think give the answer to that. So we decided it was a case of CCFC comprising SPPI test. It was contractual cash flow characteristic. I think I got the answer now. So it is called contractual cash flow characteristic comprising solely the payment of principal and interest that decides the presence or the absence of a risk. And in terms of equity, it was again the same test. It was again the same test in this particular case, again using CCFC comprising SPPI test. So in terms of the step number 2, when you're evaluating the presence or the absence of a risk, we've got a common test in terms of debt equity. The step 2 only focuses on the assessment, risk is there or the risk is not there. And then we go to the step number 3, where you have to reconfirm. If you say that yes, there is no risk, you reconfirm yes, there is no risk. And when you say there is a risk, we start looking at the intensity of the risk. Then we decided we will start looking at the intensity of the risk. And you would land up saying either the risk is high or you'll end up saying that the risk is not that high, comparatively less. So when you say that the risk is high, we understood that we could use an approach that is called FVTPL. So when the risk is going to be high, we will use the concept of FVTPL. And if the risk is low, we're going to use the concept of FPTOCI, a fair value through other comprehensive income. And when we say that there is no risk, then we decided we will use the concept of an amortized cost. That was a quick inputs. In terms of the thought processes on the 3-step, how do you decide the measurement base? So let's, I think, quickly walk through this. Then we're going to make some separate charts on debt equity investments separately. So the input. When you're looking at a subsequent measurement, the first thing you need to see is, as the holder, you step into the shoes of the issuer. You start identifying that if you would have issued the instrument, what do you call it as? The financial liability for the issuer is a debt investment for holder. An equity instrument for the issuer is an equity investment for holder. A compound financial instrument is supposed to be a debt investment. So what is important is to classify the debt and equity investments from the holder's perspective. Then your focus turns on to the assessment of risk. In second step, you're looking at risk is there or risk is not there. In third step, you reconfirm the risk is not there, and if it is there, you start looking at the intensity of the risk. That is the risk high or is the risk low? Because we decided a total of three inputs. When you see there is no risk, you'll end up using an amortized cost approach. When you say that there is a risk which is high in nature, we'll end up using a fair value through P&L. And when you say that it's a midway, it's not that there is no risk, it's not that the risk is high, but it's somewhere in between, then we'll end up using a fair value through other comprehensive income. The focus in terms of step two to decide the risk is there or not is a common test called CCFC comprising the SPPI. But when you look at the intensity of the risk, when you look at the intensity of the risk, in this case, you've got a different test for debt investments and you've got a different test in terms of equity investment. Would you like to recall and tell me which test was there in terms of debt investment? When you look at the risk, that is the intensity from a debt investments, what is the risk or what is the model which makes an evaluation? And that's wonderful indeed. It's called the business model test, the BM test. And in terms of the equity, we decided that there is going to be a different test. And what was that test? That is called HFT, held for trading test. That is called held for trading test, which is going to help you to decide the intensity of the risk. That was a broader structure which I gave you. Now we're going to make separate charts. We're going to make three different charts and try to recall the inputs. Then we'll do practical illustrations on that. Let's go to the next part. So this is the mind map 1. Let's create a mind map number 2. So in the mind map number 2, I am going to consider the charts. So we're going to make some permutations, combinations of charts in this case. And we will make a total of 3 charts in this case. In the first chart, when you say that it is supposed to be a equity instrument for the issuer, we'll end up saying it's an equity investments, chart 1. Second case, where the issuer says a financial liability and you say it is a debt investments, chart 2. Then we're going to consider a third chart where it says it is a CFI and he says it's a debt investments. So I think we'll work upon all the 3 charts. Then I think maybe we can make another mind map as well, or maybe after the question, giving you a summary of all the different categories of financial assets and all the different kind of considerations which works in terms of the financial assets. Yes, we're going to do that maybe after the questions. Okay, first, let's go to the chart number 1. I hope, friends, as we are making a walkthrough in terms of the different inputs, you are able to recall the things you've covered in the regular sessions. I hope so, that you're able to recall all the dots connected out there. We are going through the process, the thoughts, and the mind maps combined to revive the knowledge and to do the questions. I hope so. Okay, so any inputs on that? I didn't get a yes or no on that. Okay, I got a yes on that. That's great. I was expecting a little more yeses on that. I think just a few yes, means that, you're still struggling to revive it. Okay, so let's make the chart number 1. And this is with reference to equity. So we're going to make this chart in terms of equity, step 1, step 2, and the step 3. So let me, I think, start putting some questions back again. So this is my step number 1, this is my step number 2, and this is my step number 3. We step into the shoes of the issuer and it is classified as equity instrument. So we classify the instrument from the holder's perspective, and this is going to be called as equity investments. I think this we have very clearly mentioned that what is supposed to be equity instrument for the issuer becomes an equity investment for the holder. Then in terms of the step number 2, you would apply the CCFC comprising SPPI test. You would apply the CCFC comprising the SPPI test. In other words, what you're looking at, what I also told you, that you need to basically put a question to the issuer. In step number 2, you basically put a question to the issuer, and in step number 3, you basically put a question to the holder. The step number 2 would assess the risk when you're putting a question to the issuer, asking him that are you going to pay the interest on my principal? Are you going to pay the principal money back? So what do you think? This test will fail or this test will pass in terms of equity investments? And that's right, it's 100% going to fail in this case. So this test will definitely fail, indicating that yes, there is a risk. And then you go to the step number 3 and look at HFT test, that is held for trading test. So now the question is being put to the holder and you're asking him, what is your intention in terms of investing in this? He says, yes, I am going to do trading. Or he says, no, I am not going to do trading. So if you remember that if he says it is going to be trading, in this case, the risk is high and we'll end up using FPTPL, a fair value through profit and loss account in this case. But remember, if you say that it's not held for trading, then don't say FPT OCI, then it is a choice between FPT OCI and FPTPL. So the moment you say a no, you get a choice. And the choice is in terms of FPTPL, or the choice is in terms of FPT OCI. And in this particular case, what is important to remember is that this choice is supposed to be an irrevocable option. This is supposed to be an irrevocable option. Once you choose a particular category, you cannot take a U-turn. And we said, that by default, we will consider FPTPL. It's only that, if the examiner tells you that the company has taken an irrevocable option choice, then we consider FPT-OCI. So by default, you're going to consider FPTPL. So this is a choice which is by default. If I am not given anything to the contrary, then I would consider by default FPTPL. But if it clearly makes a mention that I'm supposed to use an irrevocable option, then it is FPT OCI, and this is no reclassification. This is on the chart number 1. That is when you're looking at an instrument which is equity investments from the holder's perspective, and you make the assessment, the step 2 will 100% fail. And in terms of step 3, when you look at the intention of the holder, and it says that we're going to do a trading, it becomes risky. Otherwise, you get a choice. So, in other words, one we can say equity investments by default are taken at FPTPL. It's only that if irrevocable options are chosen, then it is FPT OCI error. Great. Now let's go to the chart number 2. So now let's go to the chart number 2. And in terms of the chart number 2, we are looking at now the debt investments. We're looking at the investments, which is a financial liability for the issuer, and it becomes a debt investments for the holder. So let's make the 3 steps out here. So you can use these mind maps and you can add on your value additions. This is going to be easy to quickly recap and remember the crucial concepts in this case. Because I'm doing my bit, you can also add your value additions to whatever tailor-made you want to make these mind maps to your needs, and you can use them at the exams before revisions. So we've got a step number 1, step number 2, and a step number 3. Now, the first thing we're looking at in step 1 is stepping into the shoes of the issuer, and then we decide things from the point of view of the holder. So from the issuer point of view, we are saying that it is a financial liability. So from the holder's point of view, it becomes a case of debt investments. Then you go to the step number 2, the test remains the same, CCFC comprising SPPI. So we look at the CCFC comprising the SPPI test. And remember, the focus is you are putting a question in this case to the issuer. You're indirectly asking a question to the issuer. Are you going to pay me the interest? Are you going to pay the principal money back? So what do you think? Is this test going to pass or is this going to fail? In terms of a financial liability.
Pass, sir.
Wonderful indeed. So this test will definitely pass, and therefore this indicates for the time being that there is no risk in this particular case. Then we go to the step number 3, where we need to see the business model. This is looking at the intentions of the holder's perspective. So you're looking at what is the intention. So now the focus for the question changes to the holder, and you tell him that what is the intention. What are you going to do with this particular investment? And we decided that there will be 3 permutations, combinations with regard to the intentions. One is that it is going to be held till maturity. The other one is that it is supposed to be held for trading. And the third could be a mixed model. You may hold it till maturity or you may go in for a trading. If you plan to hold it till maturity, that means there is no risk and we'll end up using an amortized cost approach. If it is held for trading, it becomes risky in nature, and then it is supposed to be taken at FVTPL. And if it is supposed to be a mix, it becomes in between the two, which means the risk is there, but not that high. So in this case, we'll end up considering FVTOCI. And in terms of debt, it is always a case of reclassification. And another thing which I would also like to remind you at this stage without getting into the technicality. When you consider that this investment is taken at AC or it is taken at FPTOCI, it can also be designated at FPTPL. So a financial asset meeting the parameters of AC or the financial assets meeting the parameters of FPTOCI are, I'm talking about debt investments, they can be designated to be measured at FPTPL, but that is supposed to be a thing which is based upon the conditions, and those conditions are called eliminating or reducing the accounting mismatch. We did an extensive discussions on that particular concept as well. So we can say that the company can choose FPTPL, but this is based on the condition. This is based on the condition that it reduces or eliminates. It reduces or it eliminates what is called accounting mismatch. So unless, of course, this is given in the question, we are not going to use FPTPL. It's only that when there is a clear-cut mention that in spite of meeting the category of AC or in spite of meeting the category of FPT OCI, the management decides that we got the objective of reducing or eliminating accounting mismatch, we are going to take it as FPTPL. And this FPTPL is what we technically call designated. This is what we technically call that it is designated to a fair value through P&L approach. Great. So I think my chart number 2 also gets done on that. Now let's go to the chart number 3. So we've done the case of equity investments. We've done the case of debt investments where it is FL for the issuer. Now the debt investments, CFI for the issuer. So let's go to the chart number 3. So in terms of the chart number 3, we are now focusing in terms of CFI. Step number 1, 2, and 3. So in terms of the step number 1, we step into the shoes of the issuer, and it says it is a compound financial instruments. So from the holder's point of view, we would call this as a debt investments. And then we apply the CCFC comprising the SPPI test in this case again. What do you think? Are you going to pass or are you going to fail this particular test? Yes, that's right. Generally, it will fail. That's great. So we can say generally it is going to fail. And if it is going to fail, are you going to apply the step number 3 or are we going to directly make a conclusion that it is FPTPL? That's rightly said. So there is no need in terms of step number 3. You would directly say that it is risky and it is going to be taken at FPTPL. Okay, I think now we've connected the dots. So let's, I think, just reconnect a few dots based on, the mind maps which I given you. So I'm just going to quickly take this. This was my mind map number 2. Okay. So I think let's connect the dots before we start doing practical illustrations on this. When you look at the financial assets from a measurement perspective, your mind needs to be very clear. Initial measurement is at a fair value, but there are 2 exceptions when we take a transaction price, a trade receivable, as well as a loan recoverable on demand. We also need to keep the considerations that if there is a difference in the transaction value and the fair value, that is another mind map still awaited. How do you tackle the difference? That's one. The concept of EC, FPTPL or FPT-OCI is only meant for a subsequent measurement. It's nothing to do with the initial measurement. Subsequently, your mind should work on these 3 charts that you step into the shoes of the issuer and you classify it as debt or equity investments. What is FL is a debt, what is CFI is a debt, what is equity instrument is equity. Then in terms of step 2, for debt investments which are FL, you'll pass it. For CFI, which is a debt investments, you'll fail. For equity, also you're going to fail. So in terms of equity investments, it all depends upon trading or not. If it is trading, then it is FPTPL, and if it is not, there is a choice. By default, the choice is FPTPL from the examination perspective, unless we are given that you choose the irrevocable option. In terms of debt investments which are in FL, your mind should work on the business model. If it is maturity, AC, trading, FPTPL, dual model of maturity as well as sale, then it is equity OCI R. Remember, equity is NR and debt is R. And then when you look at CFI, by default, you can say it's going to be FPTPL. I did not make the 4th chart, but I think let's just quickly remind you that if you've got derivative investments, they are taken at FPTPL. So I think let's put that directly. So this is the chart number 3. Let's, I think, also put a small chart number 4. So that everything is, complete conclusively. So when you're looking in terms of derivative investments, When you're looking in terms of derivative investments, undoubtedly risky, and that is FPTPL. I have some quick questions now to put across to you. I'm going to make a total of 4 statements, and you need to vouch me is the 4 statements correct. Then we can come to the practicals. Can I say equity investments by default FPTPL? Can I say equity investments by default is FPTPL? Correct. Can I say derivative investments by default is FPTPL? And that's also correct. Can I say if it is supposed to be a debt investments, which is CFI, that is also FPTPL? Oh my God. That makes life simple. You've got equity investments, you've got debt investments in CFI, you've got derivative investments FPTPL. That's the moral of the story. And can I say if you've got debt investments in the nature of financial liability, it all depends, correct? That all depends upon the business model, maturity, trading, or a dual model. I think that makes life simple. So when you look at a question and you see it is equity investments, FPTPL, derivative investments, FPTPL, debt investments in CFI, FPTPL, debt investments in FL depends upon the business model. So if you look at the entire inputs, leaving the debt, derivative part, there are 2 categories of equity investments: OCI, that is R, NR, and PNL. 3 categories of debt investments: EC, PNL, as well as OCI-R. You want me to first make a chart indicating the entire inputs on the initial subsequent measurements, or first do the questions and then make the chart? Your choice. So you want me to first make a comprehensive chart giving you the inputs on all these 5 categories and then do the questions? Or you want me to first do the questions and then come to the chart? The chart first, that seems to be a good, safe idea. Okay, so let's, I think, consider this. So we are going to consider an interesting summary chart that becomes my mind map number 3. So this is my mind map number 3. And this is a summary chart. This is a summary chart with reference to the financial assets measurement aspects. This will give you a bird's eye view of all the inputs at a single go, that how do you look at the different categories of financial assets. So I guess we can consider, I think, first 2 broad columns. Let's consider first of all 2 broad columns. Want to look at equity investments in 2 categories, and I want to look at 3 columns for the debt investments. That will give us all the permutations and the combinations. So let's consider equity investments. So this is equity investments. This is debt investments. We are considering FVTPL, FVTOCI, that is NR, AC, FPTPL, FPTOCI, that is R. So you can see all the broad categories in terms of different investments, debt, and equity, all the broad categories. Okay, let's begin with, first of all, the aspect of initial measurement. And let's also talk in terms of TC as well. Let's also talk in terms of TC as well. Can I see in all these cases it is a fair value and TC is added except FPTPL? FPTPL, the TC is not added, but in all these cases, the TC, the transaction cost, is going to be added. So this will be initial measurement at a fair value. This will be at a fair value plus a transaction cost. This will be at a fair value plus a transaction cost. This is going to be at a fair value, and this is again going to be at a fair value plus a transaction cost. So I think the only two cases where you can see that the TC is not taken is these cases. FPTPL with a debt or FPTPL with an equity. So we can say that TC is expense to profit and loss. It is expense to the profit and loss in this case. You immediately expense of the transaction cost in the profit and loss itself. Next, the second I'm looking at is the subsequent measurement. The second I'm looking at is a subsequent measurement. And in terms of subsequent measurements, I'm looking at two inputs, the use of effective interest rate. And the second is the capturing of fair value changes. So there are two inputs going at the back of my mind. When you're looking at a subsequent measurement, I'm looking at, are you going to use the concept of EIR, and are you going to capture the concept of fair value changes or not? So can I say, is the concept of EIR applicable to equity investments? Yes or no?
No, no, sir.
That's absolutely correct. So it does not apply to equity investments at all. Can I say in terms of debt investments applies only to AC and OCI, right?
Yes.
Perfect. Now coming to the fair value changes, you will definitely capture the fair value changes in the P&L. You'll capture the fair value changes in the OCI. You will not capture the fair value changes. You'll capture the fair value changes in the P&L. You'll capture the fair value changes in the OCI. So we should be clear where the fair value changes will be taken and where the concept of EIR would apply in terms of subsequent accounting. Next, let's also connect some dots in terms of the impairment, whether the concept of impairment is applicable to these categories. So can I outrightly say that equity investments are not impairment tested?
Yes, sir.
That's right. So in this case, impairment is never applicable to equity investments. In debt investments, AC is a yes, OCI is a yes, but FPTPL is not applicable. Let's also consider the number 4. What happens if there is a sale of investment and there is a profit or loss on sale of these investments? Can we say P&L for all, or are there any exceptions? The profit or loss on sale, can I say P&L for all, or is there any exceptions?
NR to OCI.
That's right. In terms of equity investments, the profit loss goes in OCI, rest is all P&L. This is the only exception. If you've got equity investments, then the equity investments gain or loss, though realized in nature, enters the other comprehensive income. And I think let's also add another piece of input, that you will get some accumulated balance in OCI, that is in tab number 3. We need to understand where are you going to put that money in the tab number 3. Because whenever you consider the amount in other comprehensive income, it goes in statement of changes in equity in the tab number 3, which is other comprehensive income. So what do you do with that particular balance? Can I say in FPTPL, it's not there? In OCI NR, would you like to tell me where do you put that money on the sale of the investment?
Transfer to tab number 2 directly.
That's right. It is directly transferred to the tab number 2, that is retained earnings. In terms of AC, it is not applicable. In terms of P&L, it is not applicable. But in terms of OCIR, Can I say it is transferred where?
Transfer to P&L.
That's right. It goes in the profit and loss. The accumulated balance is recycled in the profit and loss. I think that takes care of all the inputs in terms of the measurements, permutations, combination, which gives you a bird's eye view. So the key focus points in this particular chart is the concept of EIR, applicable in which cases, the fair value changes are captured or not. The concept is in terms of realized gains or losses goes where. It is by default, of course, P&L, but in terms of equity OCI, it goes in OCI. So the use of EIR applies in which case is important to understand, and the realized gain or loss goes which place, that's I think important to understand. So we can see in this chart that there are 5 cases to be dealt with, 2 cases of equity and 3 cases of debt. I think we can just mainly concentrate on the debt. And I could have put something more in this chart, which I've intentionally not done. I have a separate question dealing with that. If there is a foreign exchange gain or loss, how do you tackle that as well? Not in this chart. We'll take care of that separately. So far, so good. I think my mind map's done. Time to do some questions now. So let's, I think, do a question with you. So this is question 5. Let's now read the inputs and we're going to solve this particular question. It says on 1st January X1, Tokyo bought 1 lakh 5% bond for 95,000, incurring an issue cost of 2,000. I also give you some inputs in reference to the concept of EIR, and I think I did not pen it down in my mind maps, but I think I'm going to just now recall the concept. That when does the concept of an EIR trigger? If you recall, I've given you a total of 3 inputs when the concept of EIR triggers. If you see a discount on issue or redemption, if you see a premium on issue and redemption, if you see the presence of a transaction cost, can I say that would indicate that there is a need to calculate the EIR? I think let's
Yes.
pen that down in
Yes,
terms
sir.
of a mind map. Yes. So I think in terms of the EIR, let me just add on the things that the concept of EIR triggers. The concept of EIR triggers, you can say under 3 circumstances. Number 1, you see discount on issue or redemption. You see a premium on issue or redemption. And you see the presence of a transaction cost. Trust me, whenever you're doing questions and you see in the question that there is a data which is talking about a discount on issue or redemption, there is a premium on issue and redemption, there is a transaction cost, that would immediately tell you that yes, there is a need to compute an effective interest rate, especially when you're considering the concept of EC or OCI in terms of debt. Now let's come back. So we are given that there is a issue cost and that indicates a TC. Does it trigger the concept of an effective interest rate? Yes. The interest is received in areas, the bonds will be redeemed at a premium. And that also indicates the presence of things. And there is even a discount on issue. So we can see that there is a discount on issue. We can see that there is a premium on redemption. And we can see a TC, all the 3 elements again. And therefore, we are given the effective rate of interest is at the rate of 8%. Now, since we see that there is a discount, there is a premium, and there is also a TC, the EIR is given. By the way, let me also ask you, if this EIR is not given, does this represent an internal rate of return? If this EIR is not given, does this technically represent an internal rate of return?
Yes, sir.
Yes, that's correct. Because what is called internal rate of return in financial management is called the effective interest rate in financial reporting. The fair value of the bonds is given, and then it says explain with calculations how the bonds will be accounted for in the relevant years. Now, it says the business model is to hold until the redemption date. So, which measurement base are you going to use? The business model is in terms of holding it till the redemption date.
Amortization
So
cost.
that's going to be amortized cost. That's right. Because when you're saying it's a business model, it is indicating it's a debt investments. Then he says the Tokyo's business model is to hold it until redemption, but also to sell them if you get higher returns. Becomes a mixed case.
Mixed case.
So can I say FVTOCI, and that
Or
is R. Then he says the Tokyo's business model is to trade the bonds in the short term. And that means this is supposed to be FPTPL. So I've got all the three cases. And then it says the requirement to recognize a loss allowance on a debt investment at amortized cost or FPTPI should be ignored. He is indirectly telling me that don't get worried on the impairment loss. The impairment loss can be ignored in this particular case. Okay. So I think let's now do this question, and we're going to do this from three model perspective. Number one, if it is AC. Number two, it is OCIR. And number three, it is case of FPTPL. Okay, so let's do the solution. So this is question 5. Solution to question 5. So I think first let's take the case of a debt investments at AC. So I always prefer to make a ledger account that makes life more simple. So let's consider the financial assets. The initial measurements will be done, let's see at what value. So 95,000. 95,000 is the value at which you bought this, and there is a TC of 2,000. So that works out at 97. Somebody's noise at the back. So this is 97,000, and now we are going to consider the France income at what rate? Are you going to take the France income at the contracted rate of 5% or the EIR at the rate of 8%? That's right, we're going to consider 8%. So on 97,000, we take an 8%, that is 7760. And then we receive some money which is at the contracted rate 5% on the face value. This is what you collect at the end. So what will go to the profit and loss account of the company? Are they going to capture 5,000 in the P&L, or are they going to capture 7760 in the P&L? The receipt amount, yes, 7760. The amount which is taken on the EIR, that is the France income to be captured in the P&L. So just to be on the safe side, this is the amount which will be credited to the profit and loss account. So I think this is for a period of 3 years, I guess. January X1, yes, December X3. So we just need the ledger for another 2 years. The balance CD will be a balancing figure because we are not considering fair value in this particular case. So this is 99,760. This becomes the opening balance in the next year. We again take a France income at the rate of 8%. That is approximately 7981. Then we again receive that 5,000. And we get a balance CD again as a balancing figure. Fair value changes are not to be captured in this case. This is 102741. This becomes the balance BD 102741. Last year you can take the finance income as a balancing figure. So let's see what is the collection. You're going to get that 5,000 interest, and you're also going to get the principal. And in terms of the principal, I am given the bonds are going to be redeemed at a premium of 5960. So you're going to get the face value plus the premium 105960, and we can take the finance income as a balancing figure for more accurate results. I guess this works out at 8219, and you can make a check. Is this coming to almost 8% on the balance BD? Yes, almost more or less. I think 3-4 rupees difference. That's perfectly fine. So I think this gives me the debt investments taken at amortized cost approach. Simple and straight. You keep recording the interest income on EIR, and then no need to consider fair value, just the balancing figures. Okay, let's go for the next one. That is a case of debt investments at FVTOCI, that is R. Let me, I think, quickly put a question to you at this stage. Is the finance income captured in terms of AC and in terms of OCI? Is that going to be same, or is that going to be different?
Same.
That's right, it's going to be same, because when you're capturing the finance income, it's going to be taken on the basis of EIR in both the cases. So we can take the financial asset. Let's, I think, more or less replicate this information. So you invest 97,000. You get the finance income, which is 7760. You also capture the receipt, that is 5,000. Can I say the only difference is you cannot take the balance CD as a balancing figure, but you're going to consider the fair value.
Yes, sir. Only that is the only changes, differences. The
Yes,
fair value changes to be
absolutely.
incorporated.
Perfect. Wonderful. So we can say that this is the fair value, 1,10,000. So we consider this as 1,10,000. And where will you take the differences in the ledger account? Fair value changes.
Goes to OCI.
That's correct. So we get 10,240 coming on the debit side. This goes in other comprehensive income. And just to remind you, can I say this amount is going to be taken in the tab number 3 of statement of changes in equity. This amount will get accumulated in the statement of changes in equity in the tab number 3. Once you make a sale of the investment, this amount will be put in the profit and loss as we decided in the chart. But am I given that I'm making a sale of this investment? No, I'm not given. It says it's a dual model, but I'm not given that I'm going to sell these investments. So let's keep it till maturity, though we've got a dual object. So we take a balance BD, that is 1,10,000. We again consider the finance income, 7981. We again consider the receipt of 5,000. And we take the fair value at the end of the year again. So fair value is now 1,04,000. So we again get the difference. That would be a fair value gain loss. I think this is 8981. This goes in the other comprehensive income. Okay, and then finally in the third year, we get the balance BD, and that is 1,04,000. I think let's take this finance income, 8219, and we record the figure through bank. That's 5,000 plus 105,960. Again, we get the differences in terms of the fair value gain loss. 8219, 1,04,000. I think this is coming to 1259 on this side. This is again going to be captured in the other comprehensive income. Now, a small little question at this particular stage, just for a conceptual clarity point of view. If you take the accumulated balances in OCI, these are the three balances in the accumulated other comprehensive income. Let's take the total. It's 10,240 credit minus 8981 debit minus 1259 debit. The accumulated balance in tab 3 is becomes 0. Is this by chance that it has become 0, or do you think it is bound to be?
Got to be.
Yes, because you never sold the investments and the gain could never ever get realized. If the gain could never ever get realized in this particular case, we can say this is undoubtedly a case where you can say that the sum total of the unrealized gain loss will become 0. Had you sold the investments before the maturity, then this amount accumulated would have gone to the P&L. But since you landed up keeping this investment till maturity, the unrealized gains losses, over a period of time will never get realized in nature, and they will automatically get over in the tab number 3. Okay, so this is the case number 1 and 2, debt. Now let's look at the third one. So now we're looking at the third one, and that is a case of debt investments at LPTPL. So are you going to apply the concept of EIR in this particular case?
No, sir.
That's right. So can I say the only thing is you're going to capture the fair value changes in the P&L at the end of each year. So I think in this case, let's, instead of doing an accounting, let's first make a timeline. So we can just see a timeline. So this is at time 0 when you invested. Do we take 95 or do we take 97? Do we take 95 or do we take 97?
95.
95,
That's
sir.
right.
2000
Because
goes
in this
to
particular
P&L.
case, the TC cannot be added. So what we can do at the inception, the entry would be financial asset gets a debit of 95. The bank gets a credit to the extent of 97. And that 2000 transaction cost is going to be debited in the profit and loss immediately. So the initial recognition is going to be at 95. Then I think let's see the fair value. The fair value is supposed to be 110 and 14. So the fair value is 1,10,000 and the fair value is 1,04,000. So now we can simply compare and capture the fair value changes. So from 95 it became 110. So there is a gain of 15. So the entry becomes financial asset gets a debit, the profit and loss gets a credit to the extent of 15. Then again there is a fair value change, and this fair value change means a decrease. So you put the entry profit and loss debit, and the financial asset gets a credit, and that is to the extent of 6,000. So no EIR concept. The only thing is we will keep on continuously capturing the fair value changes in the profit and loss. And by the way, can I say, if you were to capture the interest income in the P&L, how much interest income will you capture in the profit and loss every year?
5%.
That's right. Whatever actual interest you are receiving, that actual interest of 5,000 will be captured in the profit and loss year by year. So I think this becomes absolutely simple and a straight accounting. Wow. So I think my debt investments, all three categories done. Equity investments, I don't think so. We really need to do a question on that, because equity investments at PTPL, trust me, is 100% the same. And equity investments OCI, in that particular case, you just need to add the TC, and instead of taking the fair value changes in PNL, you take the fair value changes in OCI. So I think I'm not doing a question based on equity investments at PTPL OCI. Pretty simple and straight. I think that helps, right?
Yes, sir.
Okay, so now let's go to the next agenda. Let's do the next question with you. Now, this is interesting. This is one of the questions which came in RTPs, a blend of foreign exchange combined with financial instruments. Two questions came in the exams, came in the RTPs. This was another one that is November 20 RTP. This is also a blend in terms of 21 and 109. I think that's going to be a good treat. So let's, I think, have a look at this question first of all. Question 6, which is revisionary test paper. So let's read the facts of the case. It says on 1st April X1, M raised a long-term loan from foreign investors. Is that a financial liability or is that a financial asset? It raised a long-term loan. So can I say it becomes a financial liability? Though I have not discussed the financial liability, but you know that financial liabilities are measured at AC or FPTPL basically, unless it is a case of designated at FPTPL. So I think the financial liability at AC is a mirror image accounting of financial asset at amortized cost. The way you do the accounting for FA at AC, similarly you do the accounting for FL at AC. And in fact, I would also like to remind you that the financial liability component of a CFI, that is exactly the way a financial liability accounting is done. So whether you say it's the financial liability component of CFI, is the accounting same as FLAC? Yes. Is the financial asset accounting AC, FL at AC is a mirror image accounting? Yes. So it says the company raised a long-term loan and the investors subscribed 6 million foreign currency loan notes at par. It incurred an incremental issue cost. So can I say, as I read the incremental issue cost, which means TC, what triggers in your mind?
EAR.
That's right. Interest is payable annually starting from 31st March X2, and the loan is repayable at a premium, and the effective interest rate is given 12%. So in this particular case, we are very clearly given the EIR, and then it says the appropriate measurement basis is supposed to be amortized cost, very clearly stated. Then he says the relevant exchange rates are given. I am given the exchange rates at the beginning, at the end, and the average. And the functional currency is supposed to be Indian rupee. What would be the appropriate accounting treatment for the foreign currency loan in the books of M for the year X1, X2? Calculate the initial measurement for the loan, calculate the France cost for the loan, calculate the closing balance, and the exchange gain or loss as well. Now, this becomes a blend in terms of financial instruments with a foreign currency factor. If you remember, even in the regular sessions, I made a very clear-cut mention that in these kind of cases, don't even look at the foreign currency at the inception. Just ignore the element that there is any foreign currency inputs given. Do the question the normal way, considering all the data is in function currency. You can later on convert all the balances in terms of function currency. So the best approach would be to create two separate columns in the ledger. One is in a foreign currency and one is in a functional currency. Concentrate on the foreign currency and then reconvert into function currency. Let's see. So question number 6, let's have a look at the solution 6. So we will make a ledger account and then convert. So let's take two subcolumns on the debits and the credit side. First, we'll look at the accounting normal, ignoring the foreign currency factor. Let's do the normal accounting and then we can add on. So as we said, we took a loan. It's a financial liability at amortized cost. So this is in terms of foreign currency, that is FCY. And the functional currency is Indian rupee. So this is INR. This is FCY. foreign currency, and this is INR. Okay, I think let's begin with the data. Initial measurement. So it says we raised a long-term loan for 6 million and the incremental cost is 2 lakh. TC was added to financial asset. What about the TC for a financial liability?
Reduce.
Reduce it.
Reduced. That's right. So this is going to be 6 million minus 2 lakh. So we put the entry bank. 6 million would mean 60 lakhs minus the TC. So the transaction cost is reduced from financial liability. We'll make a chart for the financial liability also soon, but I thought let's first do the question on this. So that comes to 58 lakhs. And then we need to make the finance charge due. Can I say this will be at the effective interest rate itself?
Yes, sir.
That's right. So my EIR is at the rate of 12%. So let's take a 12% finance charge on this. 6,96,000. And then he's given us the inputs that we are making of payments at the end of each year. And that is to the extent of, I guess, 6 lakh. Since it is AC, we'll take the balance CD as a balancing figure. And trust me, the question is done. This is 58.96 lakhs. Okay, now the only agenda is to translate all this in terms of functional currency. So I think let me put some questions now to you at this stage. Can you tell me what is the rate at which the opening balance will be converted? Which rate will you convert the opening?
Opening rate.
Opening.
That's right. And what about the finance charge?
Average rate.
Average
That's
rate.
right, because it's a P&L item good. And what is the rate at which you're going to convert the payment of the interest?
Closing
Close.
rate.
Closing.
Rate.
That's going to be closing because it's paid at the end, and this, of course, will be at the closing. And then if there is any difference, can I say this will go to the P&L? By the way, is it supposed to be a monetary liability by concept of IS Index 21? Yes. Because this is a financial liability, you've taken a loan, it's a monetary item as per Index 21. Restatement at a closing rate would be required. Let's now pick up the rates. The opening is 2.5 and the closing is 2.75. So opening is 2.5 and the closing is 2.75, and the average is given to me. That's 2.42. So this is going to be 2.42. So let's get the data. This is into 2.5. This is 145 lakhs. Then 696 into 2.42. That comes to 16,84,320. This is 16.5 lakhs. And this is going to be 162.14 lakhs. So we can see the balancing figure in this that will be taken in the P&L. So 145 lakhs, 1684,320, 1650. I guess we are getting a balancing figure on this side. This is coming to 16,79,680. So this will be profit and loss balancing figure. This is by virtue of Index 21 that this becomes a foreign currency exchange gain or loss. Okay. Wonderful. So that was on the blend of a financial liability by virtue of IFRS, the Index 109, along with the concept of Index 21, that is foreign currency factor. Okay, so far so good. Let's look at another question now. Let's go to the question number 7. This is again a blend of Index 21 along with 109. which is in this case financial assets now. It says an Indian entity whose functional currency is rupees purchases USD denominated bonds at a fair value $1,000. The bond carries an interest rate 4.7% on the face value. The said interest is received at the year end, and the bond has got a maturity period of 5 years and is redeemable at a face value. So we give the face value of the bond is supposed to be 1250. The fair value of the bond at the end of the first year is given, and the exchange rates at the end of the year is given, and beginning and end of the year is given, and the weighted average rate of exchange is given. The entity determined that it is holding the bond as a part of the investment portfolio where the objective is met both by holding the asset to collect the contractual cash flows and selling the asset. Not reading further, so which is the business model in this case?
It's mixed
What a
model.
dual model.
Mixed model.
Mixed model. So he's already told you as well, this is equity OCI category. I think even if it was not mentioned, we can very clearly make out that it's a mixed model and therefore it is equity OCI R. And then he's also given you the effective rate of interest is 10%. Calculate the gain or loss to be taken in the P&L and the other comprehensive income for the year number 1. Wow. So I think again, the same systems will follow. You're going to make a financial asset, make 2 sub-columns in the ledger. One is in terms of functional currency, which can be converted later. First, do the question in a foreign currency, ignoring the concept of functional currency. So let's have a look at question 7. Solution to the question number 7. Let's make a ledger account. Financial asset at AC. So we make 2 sub-columns on the debit credit side. We will translate the foreign currency later. So financial assets at FVTOCI, that is R. So let's consider the inputs in terms of the foreign currency, USD, INR, USD, as well as INR. Okay, let's, I think, pick up the data and we can start fitting it in terms of the foreign currency. So it says we purchased the bond at 1,000 and we are given the coupon rate is 4.7. So let's, I think, first of all, capture the value at which we purchase the bond. So this is going to be bank. This is 1,000. And the finance income will be taken at 4.7, or will it be taken at the effective interest rate?
Effective interest rate.
That's absolutely correct. So we know the effective interest rate in this particular case is given. It is at the rate of 10%.
10%.
That's right. So 10% would mean 100. And then we are going to receive. Now, when you receive the interest, remember it should be taken at a face value, and the face value is given at 1250. So we need to consider the interest collected at the face value at the contracted rate. So this is coming approximately 58.75. I'm taking this 59. Okay, and then I think we can comfortably consider the balance CD, balancing figure, or the fair value.
Fair value.
That's correct. So the fair value at the end is given to me 1060. So first we'll take the balancing figure in this ledger that will go in the OCI representing fair value gains or loss. So this is coming to 19 as a balancing figure. This is going to be taken in OCI. This is supposed to be the fair value change. Okay, now I think we can apply the relevant exchange rates in terms of translating these figures. So I think let me put across the questions and you can watch me. So what is the rate at which this will be recorded when you make the initial investment? Is it going to be the rate on the date of acquisition, correct?
Yes, sir.
So more or less the opening, and the finance income will be at average, and the collections will be at the closing. The balance CD is again going to be at the closing. And what about this foreign exchange gain? This is going to be taken at what rate? What about this foreign exchange gain? Sorry, the fair value change. The fair value changes will be taken at what rate? Arises again at the year end, so would be at the closing rate itself. Let's now pick up the rates. The rate on the beginning is 40, end is 45, average is 40, 42. So opening is 40, average is 42, this is 45, this is 45, and this is also 45. Then we can get the foreign exchange gain loss. So this is going to be 40,000. This comes to 40,000. That is 4,200. And this comes to 855. This comes to 2655. That is 47,700. And I think now we can get the balancing figure, which is on account of foreign exchange gain loss. I guess we're getting a balancing figure on the debit side, that is 5,300. So where are you going to take this difference? P&L, OCI. This is the foreign exchange gain, profit and loss as per Index 21. Right, I think that takes care of the input in terms of the financial assets along with the concept of foreign exchange gain loss. Wow. So I think this takes care of my inputs on the financial assets initial subsequent measurements done. Now we come back to another agenda. Mind map 4, is it right? I think we've done 3 mind maps, if I rightly remember, correct?
Yes, sir.
Okay. So we had a little pending issue when we started our initial measurements of financial assets. And I said, if there is a difference between a transaction value and a fair value, how do you tackle the difference? So let's make a mind map on that area. Yes, I have put a question on that area as well. Yes, we've got questions on that area also. Okay, so let's first, I think, make another mind map number 4 on this area to begin with. So let's go for the mind map number 4. So in terms of the mind map number 4, my focus is now if there is a difference between transaction value versus the fair value. How do you take care of the difference in the transaction value and the fair value? So let's, I think, first of all, remind ourselves on the accounting treatment when the fair value and the transaction value differs. Now, you would recall that at the first instance, you need to identify, is the transaction at market terms or is it at off market terms? When you say it is at market terms, that means the contracted rate and the market rate is same. In those cases, the transaction value and the fair values will not differ. So your first approach in terms of looking at the question is to compare the contracted and the market rate. So when you see the CR, the contracted rate, and the MR, the market rate is same, it's at market term transaction. In those cases, we don't need to consider any differences because the transaction value and the fair value turns out to be equal. The second input is when you're looking at its off-market transactions, the contracted rate is lesser as compared to the market rate. And in those particular cases, when you see the CR is less, it's an off-market transaction. Then everything depends upon the source of the fair value. We decided that your source of the fair value could be an observable data, And if it is a case of observable data, do you recall where do you put the difference in terms of PV and the fair value? If there is a difference which arises and the fair value data is coming from observable inputs, then where do you put the difference in transaction and the fair value? That's right, it is put in the profit and loss. It is called a day one gain or loss. And when you say that it is not based on observable data, but it is based on unobservable data, in those particular cases, we need to see the relationship. And I gave you a total of 3 exhaustive relationships where you're going to take the differences and adjust. One, as we said, it could be an employer-employee relationship, which typically happens in terms of concession loans. And we said in those cases, the differences is taken as a prepaid staff cost and which is amortized over the period of the loan. The second relationship we identified was a case where it is a parent-subsidiary relationship, in which case the difference is taken as a deemed investment done by the parent in the subsidiary. And then we went to the third case where there could be a customer-supplier relationship, where you enter into a lease transaction with the other person. And in those particular cases, the differences is taken as a right of use asset. The difference in transaction and the fair value is captured as a part of the right of use asset, and that is depreciated over the tenure decided as per Ind AS 116. I hope you're able to connect the dots. So I think let's make a mind map on this. So when we look at a transaction value, so we can say it's going to be again a 3-step model. So in terms of the step number 1, we're going to first of all compare. We're going to first of all compare the CR, that is contracted rate. We're going to compare the CR, that is contracted rate, versus MR, and that is supposed to be a market rate. So your first focus would be to compare the contracted and the market rate in this case. So when you compare, you get 2 inputs. So either we see that the contracted rate is equal to the market rate, or we see that the contracted rate is less than the market rate. It cannot be the other way around. The CR could never be greater than the market rate. People will not enter into transactions at that rate. So when you say the CR is equal to MR, this means it is at market terms. It means it is at market terms. And if it is at market terms, the transaction value is equal to fair value. In those cases, the transaction value is equal to the fair value. There is no gap. But when you say that the CR is less than the MR, in this particular case, we can say it is at off-market terms. It is supposed to be at off-market terms in this particular case. And then there is a need to go to the step number 2 in this particular case. So the first focus will be comparing the contracted and the market terms. Next, in terms of the step number 2, we need to see the source. And I think let's make a mention that in this particular case, we definitely need to consider the fair value, and then we need to go to the step 2. So we will definitely record things at a fair value, and we go to the step number 2. So we look at the source of the fair value. We'll look at the source of the fair value in this case, and there will be 2 levels of data. Either it is observable as per Ind AS 113, or it is supposed to be unobservable. So either it is observable as per the fair value standard, or it is based on unobservable data. Now, when you say it is supposed to be observable, then we consider the difference in transaction and the fair value. The difference in transaction value versus the fair value is supposed to be taken as a day one gain or loss, and that day one gain or loss is taken in the profit and loss account itself. And if it is unobservable, then we're going to go to the step number 3 to decide the kind of relationship. Because it is the relationship which will decide where the differences are to be captured, and it is to be amortized over what time factor as well. So we will look into the type of relationship. So we'll look into the step number 3 in terms of the type of relationship. And I think let's make an input further. We made a very clear-cut distinction that in terms of the type of relationship, it is not an exhaustive list which I'm giving you, but based on the past examination questions, you would see that there are typically, 3 kind of relationships you confront: employer-employee, concession loans, customer-supplier, security deposits which are given for leased assets interest-free. And it could be a parent-subsidiary relationship resulting in deemed investments. But there can be more relationships, but that's what is covered in terms of the illustrations and the questions. So we'll scrutinize the type of relationship, and we're going to see 3 kinds of relationship, and therefore, accordingly, the accounting treatment will follow in this particular case. So the first one is going to be, you can say, a case of, let's say, employer-employee is going to be a case of an employer-employee relationship. The second case is going to be a case of customer-supplier relationship. Basically, you can say lessor-lessee. And the third is going to be a case of parent and subsidiary relationship. Parent and a subsidiary relationship. So we can see that depending upon these kind of relations, we will accordingly take the difference in terms of accounting. So in this particular case, if it is employer-employee, the difference is going to be treated as a prepaid staff cost. This is going to be treated as a prepaid staff cost, and the prepaid staff cost is going to be amortized. This is going to be amortized over the period of loan. Is going to be amortized over the period of the loan. And if it is a customer-supplier relationship, then it is treated as a right of use asset. And this right of use asset is depreciated. It is supposed to be depreciated over the tenure as per Index 116, because the tenure could be in terms of either the useful life or the lease term. It all depends upon Index 116 that if the asset will return back to the lessor, then we consider the lease term. But if it is going to be retained, then it is lease term or useful life, whichever is shorter. And then when you look at the parent-subsidiary relationship, the difference is called a deemed investment. And of course, this deemed investment is not amortized. This is not amortized. It remains as an asset. It remains as an asset. This is not amortized and taken to the P&L. Right, so this is the mind map in terms of differences between a transaction value and a fair value. How do you approach them? So I've taken 3 questions each, one on the employer-employee, one on the customer-supplier, lessor-lessee, and one is on the parent-subsidiary relationship. Okay, now let's, I think, go to the question. So let's first take a question on a staff loan. That is one of the questions in the exam. Let's have a look. It's a November 2020 examination question, came for 12 marks in the exam. So let's, I think, read the inputs in this case. It says on 1st April 2020, S advanced a housing loan of 15 lakhs to one of the employees at an interest rate of 6% per annum, which is repayable in 5 equal installments along with interest at the end of each year. So is this loan repayable in 5 equal principal installments? or is it repayable in 5 equated annual installments? When you say equated annual installments, that would be inclusive of the interest. So is there a repayment in terms of 5 principal equal installments or equated?
5 principal equal installments.
That's right. Because in this particular case, when it says the word along with interest, it is indicative that we are focusing in terms of the principal installments being equal. So I am giving the inputs. Employee is not required to give any specific performance against the benefit, and then it tells you the market rate of interest is 10% per annum. So we can very clearly see that the contracted rate is 6% and the market rate is 10%. The contracted rate is below as compared to the market rate. So this becomes a case of off-market transaction, resulting in a difference in transaction value and the fair value. The accountant of the company recognized the loan in the balance sheet at the amount of loan disbursed. He has taken the asset at 15 lakhs, which is not correct. The interest income is recognized again at the contracted rate, which is 6% on 15 lakh, that's 90. So the value of the asset is incorrect and the value at which the interest is captured is incorrect. Analyze whether the accounting treatment made by the accountant is in compliance with the relevant Ind AS. Then he says, if not, advise the correct treatment of the loan, interest and other expense in the financial statements for the year 2021, along with the workings and applicable Ind AS. You're required to explain how the housing loans should be reflected in the Ind AS compliant balance sheet on 31st March 2021. So I think pretty simple. All we need to do in this particular case is first tell the examiner that the CR is less than the MR, resulting in off-market transactions, and therefore the transaction value and the fair value would differ, and based on the relationship, it will be treated as a prepaid staff cost. So let's look at the working. Solution to question number 8. So in this particular case,
One thing, sir.
yeah,
Can I?
sorry.
Yeah, sir, will we be required to make ledger in this since they are not specifically asking?
Well, technically speaking, if the question says I want journal entry, I'm just saying a journal, you need to make journal entries. So what you can do, you can make a ledger account in the working note, and then you can pick up and make entry. Because I personally believe, making entries without a ledger could be a little, technical task, especially on the calculations of the finance income and the finance charge. So it will be a good idea to make a ledger account with the working note, and then you can, take the input data and then conveniently pass the entries. Unless you're comfortable without making a ledger, then that's fine. But I feel less a mistake if you make a ledger account than the working notes.
No, sir. I was just I am perfectly fine, sir, what you said. But what I was asking, what is he specifically asking us to make in this question, sir? This I
Okay,
wanted.
okay. Let me just come back on the requirements. So he says, analyze whether the accounting treatment is in compliance with Ind AS. So first of all, you need to tell him in the running language, not in terms of any leisures or entry, that the accounting treatment is not in accordance with Ind AS. Explain that there is a difference in transaction fair value, how it is would have been dealt, and then tell what he has done. That's one part. Then it says that if it is not, show me the correct treatment of the household loans and other expenses in the financial statements, which means you should be, doing things in the working note, but in the main solution, make extract balance sheet, make an extract income statement. Because when he says that I want the correct treatment in the financial statements of S, the financial statements would mean that we are required to consider the position in the balance sheet in the P&L. So you would show that, okay, in the balance sheet, this is the value which will appear. In the income statement, this is the finance charge. So everything what I'm doing is a part of the working notes. Mainly, you need to show the extract financials and give you can
Perfect.
say, analysis in terms of what was done and what should have been done as per the relevant provisions of the EPS. Correct.
Thank you.
You're welcome. Okay, so I think at the first instance, let's begin with first of all the input that contracted rate is less than the market rate. So considering that input, let's first of all see what is the transaction value. Let's see what is the transaction value. So can I say transaction value is the loan value? So we've advanced a loan of 15 lakhs, that is the transaction value. And when you compare this with the fair value, so that we can get the difference. So would you now like to tell me how would you get the fair value? Because the difference is something which we are going to treat it as a prepaid staff cost, but how would you calculate a fair value in this case?
Present value of interest and principal repayments.
Wonderful indeed. So when you consider the fair value in this case, it would be based on the present value of the future cash inflows, and that would be in terms of the interest as well as the principal money, for which you need a chart, because in this particular case we are given that the principal is supposed to be received by the company in 5 equal annual installments. So let's go back and make a quick chart. So it says the loan is payable in 5 equal installments with interest. So let's make a chart on this. So we can just make a chart for all the years. There will be a principal and there will be an interest. And then I think we need to do the discounting and get the present value. So we can take the principal, we can take the interest, get the total and discount this and get the present value. And the interest rate will be the discounting rate is the market rate, which is at the rate of 10%. So we'll do the discounting at 10%. So this is for a period of 5 years. So I think let's now do some calculations in this case. The loan is 15 lakhs payable in 5 equal installments. Can I say this is 3 lakhs each? This is going to be 3 lakhs each payable in 5 equal installments. So interest initially is at the rate of 6%, that comes to 90,000. Can I say the interest will go down by 1/5 every year? Considering that if you're making a repayment of the loan in 5 equal installments, can I say the interest will be on the outstanding loan, so reduces by 1/5 every year, correct?
Yes, sir.
That's right. So this becomes 72. This will be 54. This will be 36. And this will be 80. So this is going to be 390. Then this is 372, 354, 336, and this is 318. And let's do the discounting at the rate of 10%. So 0.909, 0.826, 751, 683, and 621. So I think if somebody can give me the present value, that will be great. So what is the present value we will get? I think we just fit this.
3,54,510.
Sorry, can you come again, beta?
So total answer is 13,54,602.
Okay, that's wonderful indeed. Quite fast. Okay, so that comes the fair value 13,54,602. So we can get the difference between the transaction price than the fair value. So 15 lakhs minus 13,54,602, that comes to 145,398. So I think let's put the entry at the very inception. Subsequent accounting, I think you should be able to manage. So can I say at the initial recognition, the entry will be the loan, that is the financial asset, gets a debit. This is the entry which is being done in the books of the employer. So we will capture this at the fair value 13,54,602. The bank in this particular case is going to get a credit, and that is to the extent of 15 lakhs. And the balancing figure, this is going to be taken as a prepaid staff cost. So this is the prepaid staff cost, which is going to be amortized straight line over the period of the loan. So this is 145,398, and this prepaid staff cost will be amortized. This will be amortized on straight line method for 5 years. So this is going to be amortized every year on a straight line basis. Now, what you need to technically show to the examiner for the first year, because he's asking you 2021, you need to make an extract balance sheet indicating the amount of the loan. Now, I'll tell you something. If you want, we can compute the figures as well, but let me first give you a broader picture. If you're going to present the answer, it should be in the form of the extract financials. So we look at the financial statements, and we're looking at the extract financial statements. So the two components of my financial statements, one is the balance sheet and one is the income statement. Now, I think at least let's get the structure. If you want, we can compute the figures as well. So when you show the balance sheet, there is a loan. Now tell me, is this loan going to be current or non-current in nature? We're saying at the end of the first year, so is that going to be current or non-current in nature?
Non-current.
Okay, I'm afraid I would say that there is partly current and partly non-current, because the loan is payable in 5 equal installments. So you need to segregate the element of this loan. So we can say the financial asset in the balance sheet will be segregated in terms of non-current and current. Now let me first conceptually explain. How would you do that? Can I say in this particular case, you need to make a ledger account for 1 year extra? I'll explain. We are given that we want the financial statements for the year 2021, which is the very first year. So technically speaking, if you ask me, how would I segregate this? Now watch this very carefully. Let's say you make a ledger account, and my advice would be that when you make a financial asset ledger, you make it for 2021, you make it for 21-22. Now watch me very carefully on this. So you get a balance CD here and you get a balance CD here. So can I make a statement that this balance CD is going to be something which is non-current in nature? And can I say the difference between these two balance CD is the current asset? Is my thought correct? You make a ledger account for 2 years. The balance which is there at the end of the second year is something which is non-current in nature. And the difference between the two ledger accounts is what is current, because that is payable within a period of 1 year. So when he says that I want the inputs in the financial statements, tell the examiner that this is the current and non-current. I hope you got my point very clear. That what is the current and the non-current portions, right? Then similarly, when you look at the prepaid staff cost, so would you like to tell me that in this particular case, is it current, non-current, or that's again going to be split in terms of two portions? I think now you know this. So is this going to be current, non-current, or blended?
Blended.
That's right. So we will split this again in terms of current and non-current. So in this particular case, you can say that 1/5 is going to be current. The rest, whatever is the balancing figure, that's going to be non-current. Right. I hope you don't want me to calculate the figures, because that could take a little time. But I hope if you get the concept, that's fine. So this is how the balance sheet extracts will be prepared. And then in terms of the income statement, you will tell the examiner that there are two expenses. One is that you've got a finance income. And the other one is that other expense, which is the amortization. The other expense, which is supposed to be the amortization of staff cost. That is the amortization of the prepaid staff cost. And I think let me just take you back on the question and just correlate, whether we've been able to fulfill the requirements of the question or not. So let's go back and see now the inputs in terms of the requirement. It says, number one, if you read the inputs, it says analyze whether the above accounting treatment is in compliance with India's, and if not, advise the accounting treatment. It says advise the treatment in terms of loan, interest, and other expense in the financial statements along with workings. Which means you need to conceptually, first of all, analyze and tell the examiner that what the accountant did is not correct. This is the relevant provisions as per India's, and this is what is to be done. You make your ledger accounts for the loan as well as the prepaid staff cost in the workings. And then when it says that show the housing loan in the balance sheet, current, non-current, interest and other expense in the P&L. So he says financial statements. You're required to explain how the housing loan will be reflected in the index compliant balance sheet of S. I think what you asked me as a question. I think now you've got the data points very clear that your answer needs to be presented very well in terms of extract financial statements, right? I hope I stand very clear on my thoughts. You want me to compute the figures or can I skip the figures in this case? Can I skip the figures? I think the figures are manageable. You want the split between the current, non-current, or can I skip that portion, I think? I think I can skip if there is a silence. You want me to show you the split, then I can quickly, or if that's comfortable, that's fine. Okay, so I think that's manageable. I presume the silence to my advantage.
Manageable, sir.
Okay, that's wonderful indeed. Okay, so now let's come to the next part. Maybe we can give you a break. I think first, yes. Okay, by the time, I think, let me also remind you that today we will continue till 10:30 in the morning. I made an announcement last class as well. That's why, I little delayed your break as well today. So I think we'll take a break now and then we'll start back on the further inputs. So 10-12 minutes. I think please enjoy your break, relax your minds, then we'll start back on the other cases with you. Okay, thank you. I hope you had a relaxation of mind. So we were discussing the aspect of difference in transaction value and a fair value, where we got the inputs in terms of three kinds of transactions. We dealt with the concept of a case of a concession loan, employer-employee relationship. Let's look at another two cases before we go to the next agenda. So let's have a look now on a December 21 examination question. This is 5 marks, pretty simple and straightforward indeed. Let's, I think, have a look at this. It says M made a security deposit whose details are given. It's a deposit for a period of 5 years. The starting date is April 16 and the finishing date is 21. And the description is a lease, and you made the deposit on account of a lease. Determine how the above financial assets will be measured and briefly explain the measurement determined. Make necessary entries for accounting of the deposit in the first year and in the last year, and assume that the market rate for a deposit is supposed to be at the rate of 9%. Now, we made a deposit, but I am not given that there is any contracted rate of interest on the deposit, which means it seems to be a security deposit which is interest free, but the market rate is 9%. So we can say indirectly the contracted rate is 0 and the market rate is supposed to be 9%. So this is definitely indicating it's an off-market transaction. So I think in this case, we can just quickly calculate the differences. Let's go to solution 9. So in this space, considering the marks, I think it is a pretty simple one. So we consider the transaction value and we consider the fair value. And the difference is going to be treated as right of use asset. So let's see what is the transaction value. So we given the deposit is to the extent of 20 lakhs. That is the transaction value. And would you like to tell me how would I get the fair value? Present value of what? Can I say only the principal amount, correct? So we'll take just the present value of principal because there is no interest which the company is receiving, just the principal value of the loan. So principal value of the deposit. So the present value factor at the end is given 6499. So this is going to be 20 lakhs into 0.6499, and that's going to give us the present value, that is the fair value.
12,99,800.
That's right, 12,99,800, and therefore we get a difference, and the difference is 7,200,000. Great. So now let's look at the entry at the inception. I think you can definitely handle the rest of the issue. So can I say in this particular case, though, I think the discounting factor, I don't know, is right or wrong. Just see, because 6499 seems to be a little dicey to me. At 9%, 1.091234.5. No, it's correct. So we can say the entry which we're going to do is the financial asset, that is the security deposit, gets a debit. That would be the fair value, 12,99,800. And in this particular case, sorry, the bank gets a debit, I mean. So we're looking at the entry from the point of view of the person making the deposit, yes. The bank gets a credit. This is 20 lakhs. And we're going to take the balancing figure. This is going to be right of use asset that gets a debit, which is 7,200,000. So I think the accounting thereafter is simple. I guess you can easily do the accounting. The security deposit account is going to be prepared at amortized cost. You are going to calculate the finance income based on the EIR, that is that 9%, and do the accounting. I think that's manageable, right? Okay, let's come to the third case now. And this is May 2018 examination question. So let's read the inputs on May 2018. It marks examination question. It says S issued redeemable preference shares to its holding company, and the instrument terms are given. Repayment is 3 years, so allotment date is 15 and the redemption is 18. So we're given the preference shares and the dividend rate is practically 0 and the market rate is 12%. So we can see the contracted rate is less than market rate, indicate it is an off-market transaction between the parent and the subsidiary. Analyze the given situations, apply the guidance in 109 and account for this in the books of the parent company, that is the books of H. So I think quite similar. What we need to do in this particular case, again, the same exercise. So solution 10. So we will first of all look at the transaction value. So the transaction value in this case is the investment. The preference shares is to the extent of 500 lakhs. And we consider the fair value and get the difference. And how would you consider the fair value calculations in this case? There is practically no difference we are getting. So can I say the present value? I think this factor is a misprint. Let me just give you the correct one. 0.7118. Okay. So when you're going to consider the fair value, so can I say we're just going to consider the present value of 500 lakhs? So we'll take the present value of, you can say, the principal amount only, you're not getting any dividend. So 500 lakhs into 0.7118, 315.9 lakhs, and we get the difference, that is 144.1 lakh. So now let's see the entries in the books of the parent company on account of this. So can I say the entry in the books of parent is going to be, he made an investment in the preference shares, so that gets a debit at the fair value, 355.9 lakhs, and the bank gets a credit with the money paid, that is 500 lakhs. And where do I take the difference in this entry?
Deemed equity.
That's right. It's not deemed equity, deemed investment. So it's going to be deemed investment, which is going to be deemed investment in the equity of the company, and that's 144.1. Right, so I think all the three cases are done. That was pretty simple and straight. So this takes care of my financial assets accounting in terms of all the factors, that what's the input in terms of initial, subsequent, and if there is a fair value, transaction value differences, depending upon the relationships, how it is tackled. Okay, so far so good. Now we are going to go and make another chart. So let's make another chart. Though I put one more question, which is, pertaining to the concept of, there's another special issue, but I think we can't cover everything, of course, in these sessions. So I think if you remember, there was another special issue which was regard to, that there is a prepayment of loan by the employee, and that leads to the concept of, making an adjustment, splitting the prepayment collections between what is adjusted towards a loan and what is adjusted towards the prepaid staff cost. I think I'm not doing that question because that is going to take a lot of time. We've done that in the regular sessions, but just you could refer a special issue with regard to prepayment of a concession loan by the employee, which involves the split of the prepayment amount in terms of the amount paid towards loan and the amount which is towards the prepaid staff cost. Anyway, I think let's first come to another mind map that is on the financial liability. So let's close the financial assets. Let's come to the concept of financial liabilities now.
So do we need to do that from the regular class itself, that issue?
Yeah, I think you can do that because that is also, I think, one question which is, to my mind, come twice in the exam. Now, if you want, I can do that, but then we'll have to cut down on certain areas, other areas, because
That
it becomes
only
difficult to cover
o-
everything
o-
in two sessions.
only if you could cover the concept, not the question, sir. Only if you.
Oh, wonderfully taken, not an issue. So I think let me just make a quick mind map on that part then. So it's mind map number 5, right? So let's add a mind map number 5. Because as it is, the other issues which are there in the standard, once the financial assets, financial liability accounting gets done, the major element gets done. Though apart from that, we've got the concept of derecognition of financial assets liability. But I think derecognition of financial liabilities is more pertinent, which I would like to cover. And then I think if you look at the concept of impairments and in terms of hedgings, well, the frequency is not great, but I think we'll make some quick mind maps on that area. So what I'm planning to do is I'm going to make a mind map on the special issue on financial assets, then a mind map on the financial liabilities, maybe pick up one question to do on that. Then I think we can work upon the derecognition of financial liabilities and make some quick mind maps on the impairments and the hedging concept. I think that should get taken care of. I think so. Works well. Maybe. Okay, so let's consider the mind map number 5, which is on special issue related to financial assets. This is the special issue related to financial assets. Here we are making a reference to that concessional loan. Here we are making a reference to the concept of a concession loan. So at least I think let me just show you that question so that you can at least correlate in terms of what we are doing. I think the question may not be visible. It's a January 21 examination question. So basically in this question, just to give you a very quick inputs, before I discuss. So if it's not too visible, that's fine. The question is with regard to the prepayment of the loan at the option of the employee. So when the employee made a prepayment of the loan, so we're looking at once a prepayment occurs in terms of that loan, how do you tackle that in the books of accounts? So I'm going to make a mind map on that. So I would divide this, I would say, in terms of 3 stages. I think that will be a good one to do. So we're looking at a concession loan. So let's divide this in 3 stages. Stage 1, then stage 2, or you call it step 1, step 2, step 3, whatever. But I'm calling this time stage 1, stage 2, and stage 3. So let's see how we are going to tackle this. Prepayment of a concession loan. So this is a concession loan, and what we're looking at is prepayment. We're looking at a prepayment of this concession loan. How do we tackle this? The stage 1 is that you're going to first of all compare the transaction value and the fair value, get the prepaid staff cost, the usual accounting which you do. So in this case, you will compare the transaction value versus the fair value, and you are going to get the difference, and the difference is going to be attributed as a prepaid staff cost. This is what you did in the previous question as well. So something similar would be done, and a prepaid staff cost will be computed. Next, in terms of stage number 2, the day when the prepayment occurs, the day when the, rather I would say, let's make the stage 2 is that you do the usual accounting. You do the usual accounting up to the date of prepayment. You do the usual accounting up to the date of prepayment. So when I say that you're going to do a usual accounting, I think let's pinpoint this. The usual accounting would mean that you make the financial asset at amortized cost and you do the straight line amortization or the prepaid staff costs. So let me make a mention. So in this particular case, what you need to do, the financial asset, that is the loan account, will be accounted at amortized cost and the prepaid staff cost will be amortized. The prepaid staff cost is going to be straight line amortization. This is going to be a case of straight line amortization. So that would be stage two. I think this is what you can easily correlate in terms of the question which we did earlier. So in this case, the difference, the prepaid staff cost was computed and then the normal accounting was done. Now we need to see the stage three when there is a date of prepayment. On the date of prepayment, what do we do? Now, on the date of prepayment, what is to be done is we need to consider what is the amount of prepayment and compare the amount of prepayment with the fair value, that is the present value of the remaining payments. So we'll do one thing, we will compare whatever is the amount of repayment, this will be split in terms of two components. So we will calculate the present value of remaining cash flows. We will calculate the present value of the remaining cash flow. So whatever cash flows are now pending, you take a present value of all the remaining cash flows. This is the amount to be adjusted against the FA. So this present value of remaining cash flows will be credited to financial asset. And whatever is the balancing figure, this will be credited to the prepaid staff cost. This is going to be credited to the prepaid staff cost. I hope you got the conceptual dots clear. That once you get the amount of repayment, you need to see that, okay, what is the present value of the remaining cash inflows you're going to get. So this component is going to be credited to the financial asset, the loan account. The repayment minus this, the balancing figure, is going to be credited to the prepaid staff cost. I hope the dots connected, right?
Yes, sir.
Great.
Thank you.
You're welcome. Okay, so that was on the mind map number 5. Now I think let's create a small little mind map on the financial liabilities, though I think we have done the accounting already. Well, let's create a mind map number 6. It is 6, right? Yes. So mind map number 6, which is on the financial liabilities. So I think I'm not going to complicate this chart, unlike what I've given you in terms of the regular sessions, where we segregated the financial liabilities into various categories, where we said a financial liability which arises when the financial asset is not eligible for derecognitions. Then we were talking in terms of financial guarantees, etc. So I think I'm going to keep the chart simple, but you must make a reference to the concept of financial guarantees accounting, because I think that's another area which can be a good one from the examination point of view. So accounting of financial guarantees, where it is supposed to be captured at a fair value. So that is something which you must keep in mind, but otherwise just broadly considering two categories. So I'm first considering the measurement. I'm considering the measurement, that is initial measurement, as well as the subsequent measurement. So we're looking at the initial measurement and the subsequent measurement. So just to recall the inputs, can I say financial liabilities, just like financial assets, are initially measured at a fair value, with the two exceptions which are recorded at a transaction value. There is a trade payable, just like a trade receivable for financial assets, And if there is a loan which is payable on demand, these are recorded at a transaction value. Other than these two, we capture everything at a fair value. Then, in terms of the subsequent measurements, the financial liabilities by default are taken at amortized cost approach, unless they are derivative financial liabilities, unless they are liabilities held for trading, in which cases we apply an FTTPL. There is no category in terms of financial liabilities which considers the case of FPT-OCI. Financial liabilities are either taken at AC or they are taken at FPTPL. There is no category in terms of OCI in terms of financial liability. Let's pen this down. So in terms of the initial measurement, it is always at fair value. But then we said there are exceptions. So then we said there are exceptions where we consider the transaction value. Instead of recording at a fair value, it is recorded at a transaction value. And the two exceptions is, one is a trades payable.
Loan payable at demand.
Yes. So trade payable just like trade receivable, and there is a loan which is payable on demand. Other than these, all the liabilities are taken at a fair value. And in terms of the subsequent measurement, I think let's make a small chart here itself. So broadly considering two categories of financial liabilities, so we can say one is amortized cost and one is FPTPL. So I think let's put some inputs to you. Let's make a chart on the subsequent accounting. So we'll consider that if it is AC or FPTPL, initial measurements, subsequent measurements regarding the EIR and regarding the fair value changes to be captured. But prior to that, let's, I think, first put it that this AC is more or less a default category. And FPTPL is applicable. FPTPL is applicable basically in two cases. One is if it is held for trading, and one is, you can say, if it is derivative financial liability. So two exceptions when you consider FPTPL: if the liability is held for trading or if it is derivative, otherwise the default is AC. Then maybe later you can make references to the special issue, and that special issue is FG. I'm writing it as financial guarantee. The financial guarantee, which is supposed to be again FVTPL. Okay, now let's consider the inputs in this case. When you look at the initial measurement, give me the inputs now with the TC. So can I say AC will be fair value plus or minus the TC?
FE minus
Minus
TC.
T.
Wonderful. So this is going to be fair value minus TC, and this is going to be fair value. The TC is
Charge
debited
to
to
P&L.
profit and loss immediately. Next, we're looking at two elements on the subsequent measurement. One is the concept of EIR, and one is the concept of fair value changes. So in terms of AC, the EIR applies, but it does not apply if it is a case of FPTPL. And in terms of fair value changes, we do not consider fair value changes. Here the fair value changes are taken in terms of P&L. So I think financial liability is pretty straight. I think it's not too complicated as in this particular case. So far, so good. You want me to do a question on financial liability, or maybe you want me to do a question on the financial guarantee?
Guarantee.
Guarantee, sir.
Guarantees.
Makes sense? Let's do that question on the financial guarantees in this case. Okay. So let's go to a question number 14. This has come twice in the RTP. This is on the financial guarantee. Okay, so I can read the inputs in terms of this question. It says on 1st April X1, Sun guarantees 10 lakh loan of a subsidiary Moon, which the bank provided to Moon for 3 years at 8%. The interest payments are made at the end of each year and the principal is repaid at the end of the loan term. Bullet payment. If Sun had not issued a guarantee, the bank would have charged Moon an interest rate at the rate of 11%. So right now the interest is 8% with a guarantee, and had the guarantee not been given, the interest rate would have been 11%. Sun does not charge Moon for providing the guarantee. Then he says on 31st March, there is a 1% probability that it may default in the loan in the next 12 months. If Moon defaults, Sun does not expect to recover any amount from Moon. So we're given that there is a 1% probability of default. That 1% probability of default, if you recall, relates to the concept of calculating ECL, indirectly the expected credit loss. Then he says on 31st March X3, the probability has now become 3% that Moon may default in the next 12 months. And if Moon defaults on the loan, Sun does not expect her to recover any amount from Moon. Provide the accounting treatment of financial guarantee as per 109 in the books of Sun on the initial recognition and in the subsequent period ending 31st March X3. Right, so the facts are pretty straight and clear. Let's look at the accounting solution 14. So I think if you recall the concept of financial guarantee, you would remember that financial guarantee is measured at a fair value. And what is the fair value? You need to consider that what is the interest rate had there been no guarantee which is given, and what is the interest rate if there is a guarantee which is given. The difference in the two interest rates, had there been a guarantee or no guarantee, that difference represents the fair value of the guarantee. So that is the amount at which the guarantee would be initially measured in the books of accounts. Let's go back and look at the data. So the interest rate with a guarantee is 8 and the interest rate without a guarantee is 11. So what we need to do at the first instance, calculate the fair value of the financial guarantee. So we can say, what is the interest rate? What is the interest rate with no financial guarantee? It's 11%. And what is the interest rate with financial guarantee? That is 8%. So you can say that 3% basically represents the fair value of the financial guarantee. So we can express this 3% in absolute digit and then take a present value of this at what rate? We can express this 3% in absolute digit and then we can take a present value of this at what rate?
11%.
Correct. So we're going to consider 11% as a discounting rate. So what is the amount of the loan? The amount of the loan is given to us 10 lakhs. So we can take on 10 lakh rupees, there is a 3% difference. And let's take a PVIFA, which is at the rate of 11%. I think the loan is for 3 years, I believe. Yes, it's for a period of 3 years. So let's get the PVIFA at the rate of 11%. 2.444, I think. So 10 lakhs into 3% into 2.444, this comes to 73,320. That is the value. Okay. Once we get the value of this guarantee, now can you tell me what will be the journal entry to capture this amount of financial guarantee in the books of the parent company? What is the entry which we will pass in order to capture this financial guarantee? The financial guarantee, of course, gets a credit, and what is going to be the corresponding debit for capturing this guarantee?
Deemed investment.
Sorry.
Deemed investment.
Yes, it is going to be investment in the subsidiary. So we will put the entry that is investment in the subsidiary. That's going to get a debit, and the financial guarantee gets a credit. And this is to the extent of 73,320. So this is the initial recognition of the financial guarantee, which is at the fair value. The difference in the interest rate, and that is captured in the absolute data. Now let's see the accounting on a subsequent level. So let's see how would the accounting be done subsequently for this financial guarantee. So my first year is March X2. So we're looking at 31st March X2. Now, in this particular case, the standard is very clear that when you consider the financial guarantee subsequently, you need to consider two values. You need to consider what is the amortized value of this liability, that is financial liability, and you need to consider that if a default occurs, then what is the provision for ECL, the expected credit loss. So what do you consider, the value to be measured at the lower of the two or at the higher of the two? On one hand, you get the amortized cost of the financial guarantee. On the other hand, you get the amount which is payable if the default occurs. So we will capture this at the lower of the two or the greater of the two.
Greater of the.
That's right, absolutely. So we need to consider the higher of the two values. So we need to consider the higher of the two values. So we will consider number one, what is the financial liability at amortized cost approach? And what is the expected amount of provision which would have been made for the expected credit loss? So let's first look at the financial liability at AC, making a small leisure. So we can say that if I were to do this accounting at AC, then we can say it is 73,320. You can unwind the interest at the rate of 11%. On this, we take 11%, that's 8065. And the benefits given to the subsidy is 30,000. 3% of the loan value, this is the benefits paid. So this is the balance, this is the finance charge, and that is the benefits paid. You get the balance CD, balancing figure. That comes to 51,385. So we can consider this as 51,385. Now we need to consider that if a default occurs, and we have to calculate what is the amount of provision required for expected credit loss. He's given us the probability of default is supposed to be 1%. So when you consider the provision, you know the loan is to the extent of 10 lakhs, there is a 1% probability of default. I think that works out at 10,000. So we need to capture this liability at the greater of the two. So which means your financial guarantee is now supposed to be reduced to this figure. If it is supposed to be reduced to this figure, then we can put the entry. The financial guarantee gets a credit, and where will you take the corresponding debit? It is measured at FPTPL. So can I say this amount is going to be credited? The financial guarantee gets a debit, and this amount is going to be credited to which account? Profit and loss, because this is measured at FPTPL. So differences will be taken in the P&L. So let's take the difference between the two. 73,320, 51,385. That's, I think, 21,935. This is the value by which the financial guarantee reduces in the books of accounts. Now he's also asking us the accounting for the year ended March X3 as well. So again, we do the similar calculations. We need to consider higher of the two. Similar kind of calculations, consider the higher of the two. So we take the financial liability at amortized cost and we create a provision for the expected credit loss and take the greater of the two. So let's make a ledger out here. Financial liability, this would be 51385. Take the finance charge at the rate of 11%. That's, I think, 5652. The benefit paid is 30,000. So we can get the balance 51,385, 5652. This is 27037. So this is 27037. And I think the default probability, if I rightly remember, was 3%, if I rightly remember correct.
Yes, sir.
Yes, so 3% default probability would mean 30,000. So you need to record it at the higher of the two, that is 30. So which means now you need to capture this financial guarantee at the new value. So you can compare these two figures and we need to pass the entry financial guarantee gets a debit, profit and loss gets a credit, and that is 21,385. So this is the accounting of the financial guarantee special issue. So we're done now with the core accounting of the standard. If you notice Index 109, mainly if you see the frequency in terms of question, focuses on the accounting of financial assets, financial liability. So I think all the cases of financial assets with special issues and the financial liability is done. One major area stands down. Now we should go to the next area, B recognition. So I'm going to talk in terms of B recognitions of financial liability. Because I think if you look at the D definition of financial assets, I think more or less what I see the questions comes more on the D definition of financial liability. So I'm going to concentrate on D definition of. So let's go to the next mind map. And what is the number now? 7, right?
Yes, sir.
Is it mind map 7, right?
Yes, sir.
Okay, great. So we are on the mind map number 7. That is on the D recognition of financial liabilities. So let's, I think, first of all, try to recall the concept in terms of D recognition of financial liability. How does the accounting in this case takes place? If you remember, we had discussed the 3-step model in terms of D recognition of financial liability. The first is, what is the test called which evaluates the kind of treatment to be done?
10% test.
Wonderful indeed. So you need to first of all apply the concept of a 10% test, which will decide the fate of what kind of accounting is to be done. So we need to first of all consider the present value of the remaining cash flows based on original term using the original EIR itself. The second one, what we need to do is we need to calculate the present value of the new cash flows, but using the original EIR itself. So on one hand, you calculate the present value of the remaining cash flows using the original EIR, and then you calculate the present value of the new cash flows using the original EIR. Then you take the difference between the two and you calculate that as a percentage of step number 1. If that percentage is 10% or more than 10%, it means a material change, and then we apply what is called extinguishment accounting. And if the percentage is below 10%, then we apply what is called a modification accounting. The 10% test will only identify the kind of accounting to be done. Once you've identified that, then we need to see that what is the accounting for modification and what is the accounting for extinguishment. So let's, I think, first of all, pen this down. So you need to apply a 3-step in order to decide what kind of accounting will trigger. So step number 1, step number 2, and step number 3. This is on the 10% test to be conducted, which will decide the kind of accounting which is applicable in this case. So in step number 1, we will consider the present value of remaining cash flows. We need to consider the present value of the remaining cash flows, which is based on original terms, which is based on the original terms itself. And in the second step, you need to calculate the present value of, you can say, the modified cash flows, which is based on the new terms, And in both the cases, when you consider a present value, in both the cases, the present value will capture the discount rate, which is original EIR. The discount rate to be captured in both the cases is the original EIR rate itself. Now, another small little question what comes to the mind at this stage. If there is any associated transaction cost, are you going to consider that in the step number 2? When you take the modified cash flows based on the new terms, are you going to consider TC as well?
Yes, sir.
Yes, sir.
Yes.
We will consider it.
Absolutely. So I think let's put that out here. So when you consider the modified cash flows, this is including the transaction cost which you have to pay at time 0. Okay. And then we compare, then we take the difference in the values between step number 2 and 1. And you take the difference expressed as a percentage of step number 1. Whatever is the difference in step 2 minus 1 over the base of 1, and you get the answer. Either this is 10% or more, or it is supposed to be less than 10%. So if it is 10% or more, then we apply extinguishment accounting. So if it is 10% or more, we would apply extinguishment accounting. And if it is supposed to be less than 10%, then it is supposed to be modification accounting. So the focus, what we need to keep in mind is that this 10% test will only decide the kind of accounting to be applied. Once you've decided on the kind of accounting, then only we can progress further and apply the 2 accountings. Now, let's see what is the inputs once you decide modification or extinguishment accounting. So if we consider that we reach a conclusion that it is extinguishment accounting, then what? And if it is supposed to be modification accounting, then what? So let's see, once you've chosen the route of 10%, then what kind of accounting would apply? What happens if there is extinguishment, and what happens if there is a modification accounting? Now, when you say that there is extinguishment accounting, can I say the old financial liability gets de-recognized from the books of accounts at a book value? And can I say the new financial liability gets credited in the books of accounts? Can I say this is at a fair value? And is this fair value based on the step number 2 which you computed earlier? Or is this going to be recomputed separately?
Sir, we have to recompute separately using new AR.
So we're going to consider the new EIR on the basis of which we'll take that. And is this including the TC or excluding the TC?
Sir, we will not consider the TC. Exclude the
Wonderful
TC.
indeed. So we can say when you consider this fair value, so we can say this fair value is supposed to be the present value of modified cash flows. It is the present value of the modified cash flows. And when you consider the present value, you will consider the new EIR. So there is one focus point. that you consider the present value of modified cash flows, and this is excluding the TC. This is excluding the transaction cost. So the transaction cost is going to be immediately expensed in the P&L. This transaction cost will be immediately expensed in P&L. This will be immediately expensed to profit and loss. So unlike the 10% test where it was added as a part of the step number 2, in this particular case, it is going to be directly taken in the profit and loss. So this is the derecognition and this is the fair value. And what happens to the difference in this entry?
P&L.
That's right. Any balancing figure in this entry is going to be taken in the profit and loss. That is extinguishment accounting. Now let's see what happens on a modification accounting.
We are not taking the TC because the EIR itself captures the TC.
Not, I would not say that. I
Modified.
would say rather, it's more like a penalty to the company, telling them that there has been a material change. And since there is a material change, I'm not allowing you to adjust it in EIR. Because in this particular case, if you allow them to adjust it in the EIR, then the TC will get spread over the remaining period. So indirectly by telling them to put it in the P&L, it's more like a penalty to them, telling them that, if you have defaulted in the loans in such a manner that the variation, the materiality change is more than 10%, it's indirectly penalizing them. So that EIR is not incorporating the TC in any case.
Right. Thank you.
You're welcome. Okay, now coming to the concept that if you apply the concept of a modification accounting, so can I say in this case, what do we need to do? The TC which you have incurred, can I say will be adjusted to the financial liability? We will reduce the transaction cost from the financial liability. And immediately as you do this, can I say this will trigger what?
New EAR.
Yes, this will trigger the need to calculate the new effective interest rate. And based on that, you will do the accounting for the future. Simple and sweet. So this is how the extinguishment and the modification accounting will occur in the books. Let's do a practical now on this. Question number 15. So let's see extinguishment accounting. I hope that's visible, right? I guess that's visible, right? Okay, it says on January 2020, A issues a 10-year bond for 10 lakhs, bearing an interest rate at the rate of 10%, and the bonds are redeemable on December 29, 10 years later. And then it says no cost or fees is incurred, so there is no TC. So which means the interest rate, the coupon rate, and the effective rate is same because there is no TC, there is no processing fee, nothing. So that keeps the things absolutely same. Okay, now let's read the inputs further. It says on January 25, that is after 5 years, the bondholders agreed to a modification. And it says the terms are extended to December 31st, the interest payment reduced to 5%, and the bonds are redeemable on December 31st for a larger amount. There is a legal fees which is also paid. So the tenure is got extended by another 2 years. The interest rate is undergone a change and there is a TC. A determines that the market rate on January 25, that is on the date of modification, is 11%. And this is the repayment schedule which is given to us. Okay, so I think what we need to do at the first instance is apply a 10% test and then decide the inputs. So solution 15. So let's, in this particular case, first of all, apply the 10% test. So in terms of the 10% test, we've got step 1, step 2, and step 3. Can I say the present value of remaining cash flows at original EIR in this question would remain 10 lakh. If there was no processing fees and if there was no TC, that means that the fair value and transaction value were same. It was on market transaction. So it was at market transaction. So can I say at any point of time, if you take the present value of the remaining cash flows, the interest in the principal, it's undoubtedly equal to the principal amount of the loan. Is the thoughts correct?
Yes, sir.
Correct. So even if in the exams, let's say you're still worried on, is it same or not? You can always land up, doing the calculations instead of speculating. Take the remaining cash flows, discount them, but trust me, you're going to get 10 lakh. So in this case, we can directly consider the present value of remaining cash flows. And this is based on the original terms. And this is using the discount rate EIR as 10%. So this is discounting at the rate of 10% itself. So this remains 10 lakhs itself. Now let's consider the step number 2, in which we will now consider the present value, which is again going to be taken at 10% of, you can say, the new cash flows, and this will be based on the new terms, and we also need to consider the TC as well. So let's, I think, look at the data carefully to get the data. So we are given that the tenure is extended by another 2 years instead of 29. Now it is going to be redeemable on 31st. So interest payment is now 5%. So on 10 lakhs, you will pay 5%, that is 50,000. So you are going to pay 50,000 for how many more years? We need a PVIFA at the rate of 10%. How many years?
7 years.
So let me see when the default occurred. So it was on January 25. That means remaining 5 years gets extended by another 2 years, right? It's going to be 7 years. And then you're also going to consider principal repayment, which is got enhanced. The money is now redeemable at 15 lakhs. And this is going to be PVIF at the rate of 10%, which is 7th year end. And we also need to take the TC, and the TC is 1 lakh. TC is paid at time 0, so that doesn't need a discount. So 10%, 7 years, 1, 2, 3, 4, 5, 6, 7. This is 0.513
Yes, sir.
and 4.868.
Yes, sir.
So that's right. This is 243,400. I think this is coming to 11,12,900. Is that correct, I think?
Yes, sir.
Okay. So then we can take the differences in the step 2 and 1. So 11,12,900 minus 10 lakh over the base of 10 lakh. Let's see what is the change in the percentage. That's 11.29%. So that stands more than 10%. So which means we are going to apply extinguishment accounting. So this proves that we are going to apply an extinguishment accounting because the change is more than 10% in this case. Wow. So I think once you have identified that this is a case of extinguishment accounting, now we need to go and apply the extinguishment accounting, put a journal entry in the books. So let's see the accounting entry on extinguishment. So the accounting entry is de-recognizing the old financial liability. And this will be derecognized at a book value, which is 10 lakh. Recognizing the new financial liability, and this will be at a fair value. So I think we need to organize the fair value in this case. So can I say the fair value is going to be based on the market rate which is prevailing on January 25. So based on the new terms, let's go back. So we know that we are going to make a payment. The market rate is now 11%. So let's consider the discounting of all these flows. You're going to pay 50,000 discounted PVIFA at 11%, 7 years. And you're going to consider the principal repayment 15 lakhs, PVIF at 11%, 7th year end. And what about
0.482.
the TC?
Hmm.
What about the TC? Is it to be taken or not to be taken?
Not to be
Yeah.
taken, sir.
Not to be taken.
That to be expensed.
Yes.
0.482, sir.
0.43 or 0.535?
Sir, 0.482.
482.
And
Yes, 0.482, you're right. This is 0.482,
that is 4.712.
4.712. We get the present value. 235,600. 958,600, I think.
Yes.
So we're getting a difference, which is a gain on derecognition, and that will be taken in the profit and loss. That's 41,400 is the gain which arises on derecognition of the liability, and another one entry to be done as well. And that is on the TC. So profit and loss, the transaction cost will be expensed off in this case. And that was, I think, 1 lakh. Right. So I think this takes care of the accounting in terms of extinguishment. When the 10% test tells you that there is a material change, in that particular case, the extinguishment accounting applies. The old liability gets derecognized, the new liability gets recognized at a fair value, and any difference, gain or loss goes in the period. Great. So far, so good. I guess that takes care of the extinguishment accounting. Okay, then this is a similar question, which I think we can leave for your practice. Okay, now we can go to, I think, a quick revisions on the concept of hedge accounting as well as the concept of impairments. So I think let's take a quick mind map. We'll make a mind map in terms of impairment. I'm not taking a question on impairment, but we'll just do a quick mind map on the impairment aspect. And then we'll also compare a quick mind map in terms of the hedging. And if the time permits, we'll do a question on the hedging as well. Okay, so mind map number
8.
8. So we're going to get 9 mind maps. I think last class also gave you 9 mind maps. If I remember, 9 plus 9 makes it 18. So you've got extensive mind maps to make your revisions. Okay, so let's talk about the impairment of financial assets. Impairment of assets. So this is simple and straight. There is not complications on the concept of impairments. Now, if you recall, we had discussed the concept of impairment, also segregating this in terms of a 3-step model. When I gave you the inputs that first you need to see the scope of the standard, because you've got 2 categories of assets mainly. One is financial and one is non-financial in nature. If it is non-financial, you typically get covered under Index 36, which deals with impairment, typically on non-financial. And if it is a financial asset in nature, then you're covered under Index 109. And even within financial assets, you need to be clear that as far as equity investments are concerned, they're not impairment tested. But as far as the debt investments are concerned, we've seen that earlier in the chart as well, that only if it is AC and if it is supposed to be equity OCI, they get covered. The second aspect is in terms of deciding the approach with which the impairment testing is done. And there are a total of two main approaches in the standard as far as impairment is concerned. One is what is called a general approach, which is supposed to be applied by default. And the other one is called a simplified approach, but that is applied only to trade receivables, and that also if there is no significant interest element, there is no significant financing component in the transaction. Otherwise, the default approach is supposed to be general approach. Now, in terms of the difference in a general approach and a simplified approach is a general approach requires you to make a credit assessment at each balance sheet date. Because then you need to focus that if the credit risk has got enhanced, then you need to apply the concept of what is called a lifetime ECL. And if the credit risk does not undergo a change, then you can apply the concept of 12 months ECL. And this concept of 12 months ECL or a lifetime ECL will give you a probability of default. And if it is a simplified approach, then it is supposed to be a lifetime ECL. The concept of making a review of a credit assessment is not required. And then finally, once you come to the inputs, you go to the step 3, you create a provision. And the provision is based on a total of 4 parameters. One is you consider the amount which you are exposed to, that's called EAD, exposure at default. The second one is called the LGD, that's a loss given default. Considering that there might be a haircut, so you consider what is the total default in percentage which can occur, the total loss which we can get. The third is considering the probability of default computed in step number 2. And then finally, you need to see that if the time value money becomes relevant, you need to consider the present value as well. Let's, I think, document this out. So in terms of the impairment, we applied 3 steps. So the very first step is looking at the scope. The very first input is in terms of looking at the scope, and we can segregate this. Then we can say that there are typically, you can say 2 assets. One is non-financial assets and one is financial assets. The non-financial assets will be typically covered under Index 36. I said typically covered because there are exceptions where even non-financial assets can be covered under the purview of 109. The financial assets, we can say, would be either equity investments or they would be debt investments. Equity investments, the impairment is not applicable. They're not tested for impairment. And debt investments, again, we've got 3 categories. So one is amortized cost and one is FPTOCI, that is R, and one is FPTPL. So in terms of the financial assets, we are applying Index 109. And AC, yes, OCI, yes, but FPTPL, no. So you need to first of all filter that effectively those financial assets which are debt investments measured at AC or measured at FPTOCI, only they get covered in terms of, you can say, impairment testing. Then comes the step number 2. Then comes the input in terms of the step number 2, where we decide an approach. And in terms of the approach, we have 2 approaches. One is a general approach and one is a simplified approach. So the simplified approach applies in a particular case only. By default, we always consider a general approach. So when you say a general approach, this is by default. All the financial assets by default are going to be covered under the general approach itself. And as far as simplified approach is concerned, this is applies to trade receivables if there is no significant financing component as per Index 115. So based on the revenue standard, if there is no significant financing component based on 115, then a simplified approach applies, which means if there is a significant financing element, then you apply the general approach. Now, in terms of the general approach, we need to do a review of credit risk assessment. So we need to do a review of the credit risk assessment. So every balance sheet date, you need to make a review of the credit risk assessment. And in this case, if we say we need to basically question and find out that is there a significant increase, if there is a significant increase in the credit risk or not. So you need to basically put a question that is there a significant increase in the credit risk? Now, when you say yes, there is a significant increase, then we apply a lifetime ECL. And if you say no, there is no significant increase, then we apply the concept of 12 months ECL. Then the concept of 12 months ECL would apply. In terms of a simplified approach, there is always a lifetime ECL. We always use a lifetime ECL approach in this particular case. So there is no credit risk assessment required. There is no credit risk assessment. There is no credit risk assessment which is required in this case. And what is this credit risk assessment going to give you? The credit risk assessment in this particular case is going to give you, can I say, the POD. So once you use the lifetime ECL or you use the 12 months ECL, this is going to give us, you can say, the POD, the probability of default, which we need for the purposes of step 3. And finally, we apply the step number 3 in this case. And finally, we apply the step number 3 and we create a provision for ECL. And we create a provision for expected credit loss. And this is based on a total of, you can say, 4 parameters. So this is done on the basis of 4 parameters in this case. And what are the 4 parameters?
EAD, LGD, PD, TVM.
That's right. So exposure at default multiplied with loss given default multiplied with the POD, and we can say time value of money if relevant. So this gives you the inputs in terms of the provision for expected credit loss. Wow. Okay, so this was on the impairment. Now I think let's make a last mind map, which is on the concept of hedging. So that's my mind map number 9. So let's create a mind map number 9. Okay, so let's create a hedging mind map. So that is the mind map number 9. That is on the concept of hedging. And this is pretty simple and straight. If you recall the concepts, then I think this is not complicated, but I think we just need to, make a walkthrough in terms of the parameters which you need to keep in mind on this. So let's divide this in 2 parts. So we can say basically When you look at the concept of hedging, I would say there are basically two kinds of hedge. One is what we call a cash flow hedge, and one is what is called a fair value hedge. Of course, we did the basic principles. I'm not getting into that. Then you get the hedged item, then you identify the hedging instrument, and then you see that there is a formal documentations and the parameters are met. And then you see that, in this particular case, what is the type of hedge, and you do the accounting. I'm just going to create a input in terms of the accounting. So my focus is in terms of understanding that what is the accounting in terms of the hedge. So let's consider first of all the case of a fair value hedge. And let's consider the case of what we call a cash flow hedge. So there are two things. One is called the hedged item. One is called the hedged item, what you're trying to protect, and one is called the hedging instrument. And the other one is what we call the hedging instrument. And I think this accounting is pretty simple and straight indeed. So the hedged item is measured, can I say, at a fair value through P&L?
Yes, sir.
And even the hedging instrument is taken at FPTPL.
Yes.
Any exceptions? Any exceptions? Yes. Can I say
Yes,
the exceptions is if the hedged item is equity investments
equity investment and FET
at
OCI to
FPT
NR.
OCI, that's right. So can I say then the fair value changes will go to FPT OCI, right?
Yes, sir.
And even the hedged item, hedging instrument will also go to FPT OCI. So fair value hedge is pretty simple and straight indeed, because all the fair value changes, whether relates to the item or relates to the instrument, is going to be captured in terms of the profit and loss. Now let's talk in terms of the cash flow hedge. So we've got hedged item and we've got hedging instrument, hedged item and the hedging instrument. So when you consider the hedged item, do you consider fair value or normal accounting?
Normal accounting.
That's right. So this is done normal accounting. The usual accounting takes place. We do not touch this, but this is done at a fair value. I'm not saying fair value. Let's put it like this: fair value through OCI typically. But what you need to do is, I gave you the inputs. You need to basically compare the umbrella size. You need to compare, you can say the fair value change of the hedged item, and you need to compare this with the fair value change of the hedging instrument. You need to compare the fair value change of the hedged item and the fair value changes of the hedging instrument. Okay, so if this is, let's say, greater than or equal to, where do you take the fair value change?
Sir, if it is equal to, then we will move to OCI.
Yes. So I think let's not put it as greater than or equal to. Let's put it as, okay, if the fair value change of the head item, yes, greater than or equal to that. So it goes to OCI.
Both
And if
both
it is
will go to
less,
OCI. If it is greater than, it will go to.
not the entire. Can I say to the extent of the hedged item, OCI rest in P&L?
Yes, sir. The effective portion, it will go to the OCI.
Yes.
Ineffective portion will go to the P&L.
Exactly. So if it is greater, it goes in fair value change, goes in OCI. And otherwise, we can say the fair value change of item. The fair value change of the item goes in OCI, and you can say the rest goes in the P&L. That becomes an ineffective portion of the hedge. So this is the basic parameters in terms of accounting for a fair value hedge as well as the accounting for cash flow hedge is concerned. Okay, so far so good. I think we have tried to cover questions mainly from the areas which are more important, but I think conceptually, if you see, I think I'm trying to hit upon almost all the areas of financial instruments, giving you a total of 18 mind maps. I think once you revise things, do more questions, I'm confident you'll get better. And you can add on things, in these mind maps. Do whatever value additions you can do on these mind maps once you practice, so that, in the last minute when you look at these mind maps, it's going to do something really great for you. I mean, that's going to be your value additions on that. Right, friends, I think that brings me almost to the end of financial instruments. Our revision of the financial instrument is done. Now we'll be going in the next class, which I guess is not on Thursday, I think. I'm forgetting the schedule. I think it's on Sunday. I think that's right? It's on Sunday, right?
Yeah, I think Sunday, sir, on business
Yes.
combination.
Yes, so we'll meet on Sunday and we'll be doing the revision in terms of consolidation standards. So we'll pick up the inputs in terms of consolidation standards on Sunday. That's all from my side, friends. If you've got any questions, otherwise, I think that's all for the day.
Thank you so much, sir.
Thank you very much. Thank you all for joining in.
Thank
So
you
see
very
you in the next class.
Thank you.
Thank you very much. Bye-bye. Take care. Angie, thank you.